Every once in a while, after completing our cash flow efficiency audit with a business owner, and we've identified their goals, whether it be business succession, key person retention, or business exit strategies, and we'll come to find that the business owner can't get insurance. The question we're going to answer today is, how do we achieve these goals using life insurance when the business owner isn't insurable? Hi, I'm Olivia Kirk.
I'm Tim Yurek. We're from Tier 1 Capital, and we're here to show you how to regain control of your money.
Our health is one of the most fragile things that we have. One occurrence could make us uninsurable. So the question becomes, how do we still accomplish our goals that would typically be accomplished using life insurance if we can't actually get the insurance, if we can't put that death benefit on our body?
And keep in mind that one of the key or big issues that life insurance helps to solve is access to capital. And the way we design policies is for cash accumulation. So whether the death benefit is needed for business succession, key person retention, or business exit strategies, we need to have the insurance so that we have access to capital to run and grow our businesses.
Right. So we're not only using it for those long-term goals that would require the death benefit, right? With the death benefit, the occurrence that causes the problem, the death of the business owner, also triggers the solution, the inflow of cash through the death benefit. We're, in addition, using that cash value that we're growing and accumulating along the way to achieve goals for that business owner.
Yeah, and that's a great point. The easy solution here is let's look at a business exit strategy where the business owner is uninsurable. Well, we could insure that business owner's spouse or maybe that business owner's adult child. The key for the business owner is that the business owner will still have access to the cash value in the policy. The downside of doing it that way is that when the business owner dies, there's no payout because the insurance was not on him or her. And so that could be problematic, but if we're setting it up for an exit, we're really setting it up for cash accumulation.
And that makes perfect sense, right? At the end of the day, we need to find an insurable body to purchase insurance. And as long as we're able to justify the insurable interest between that business owner and the insurable body, we're able to purchase that policy. And with that, we're able to properly design that policy to accumulate the cash value so we're able to actually achieve the goals. With that cash flow efficiency audit that we go through with our business owner clients, we're identifying places where they're giving up control of their money unknowingly and unnecessarily. And at the end of the day, after we identify, we need to redirect that money into a place that's going to be more efficient and more beneficial for that business owner. And a lot of times that place is a whole life insurance policy designed for cash value accumulation because we're able to access the money while the business owner is alive and recapture that money when the business owner dies. So by instead insuring a different life, the only thing that's going to change is when that death benefit is going to be triggered, not necessarily what's going to happen with the cash along the way.
Yeah, and so again, in the exit scenario, we can look or pivot to the spouse of the business owner or an adult child of the business owner. But now let's look at the business succession. So you have two partners, A and B. A is insurable, B is not. So B insures A, but now what does A do? Well, A could possibly insure B's spouse or another employee in the business. And again, what happens is there's no death benefit payable when B dies because B wasn't insurable and we couldn't get insurance on him or her. And that's okay. The key is having control of the cash value because the hope is that both A and B will be alive on the exit. And then, so the succession is what happens if either dies between now and then, but then there's possibly an exit. And that's where the cash accumulation could come into play. A third scenario would be insuring a key person for key person retention purposes or key person insurance. And again, if that person isn't insurable, you could insure somebody else, either another employee or yourself, and again, have access to the cash value.
When we're building up the cash value within these policies, it gives us options. We're able to expand the business, invest in new equipment, invest in new inventory, take advantage of other opportunities that come along, but also we're able to do things within the business like retain those key people, have added benefits for them so that they're not going out and looking for another job.
Yeah, and that's the key, right? That's why you're buying the insurance, to use as a key person retention tool or a succession tool or an exit tool. And then you can use the cash value or access the cash value to run and grow your business, which is a side benefit that we teach our business owner clients.
In conclusion, at the end of the day, to purchase insurance, we need to have a body that is insurable, someone that's healthy enough to have a life insurance contract issued. With that, we're able to build the cash value within the contract that could be used while everyone is still alive. And eventually, depending on the person, when they die, the death benefit will be paid out. And ultimately, that's a recycling of the money, the premiums that were paid into the contract. We're able to recapture the cost of achieving those goals when that person dies. If you'd like to learn more about putting this to work for you, your business, your specific situation, we'd be happy to talk about creative ways to do so. Just visit our website at tier1capital.com to schedule your free strategy session today, and we'll do a deep dive for your specific situation. Also, if you like this video, give us a thumbs up and don't forget to check out these two. We picked them out special for you.
Thanks so much for watching our video. And remember, it's not how much money you make.
It's how much money you keep that really matters. We'll see you in the next one.